So last session today, we talked about a few things. And today we're going to talk about how to create a steady income in retirement and some strategies. We'll do a recap quickly, go over some withdrawal strategies. One strategy in particular that I like. And then we talk about taxes and how to protect your assets and create a legacy. You know me already. Again, a disclaimer, I'm a financial advisor. This is all for informational and education purposes only. No financial advice happening. So, first session, we talked about different investment options and looking at them through a risk return angle. The most important thing I thought was from the first session was the impact of fees on your portfolio, how that you need to be very careful about that. We also talked about risk tolerance and how it has three components. We did a questionnaire which included your willingness to take risk. But then risk tolerance has two additional components. One was the capacity to take risk, which depends on your asset size and a number of factors. And the third component was the need to take risk, whether there is, depending on your goals, whether you even require risk. And then the last session, like the second session, was about how you can safeguard your assets from investment products, from scams, and from behavioral aspects. And today we're going to talk about how to create a reliable income stream. So the number one question that I get asked is, am I going to outlive my assets? There are a number of withdrawal strategies, and you may be familiar with the first one, which is the fixed percentage withdrawal, the 4% rule, which came out in the 90s, I want to say. And what that rule says is, actually, before I go there, any questions from the last two sessions? Any thoughts that come to mind?
So, looking at the questionnaire about the health insurance, the thing that comes up as you look at that, it asks a lot of good questions and it asks you to research on it. But the big thing is complexity, right? I mean, it's almost like for those of us that are looking for insurance to protect us, there are all these little things they're doing to make it more complex. So, I think like I read consumer reports, right? To see product, things like that. I kind of trust them to do a decent job. I mean, is there something like that that one can turn to? Because doing some of that research, daunting. Is there a trusted source? Someone that's not trying to be commercial, not trying to get a collect on, because you can get all kinds of stuff on YouTube, right?
So open source, I'm not aware of like specific tools that one can use, but a lot of planners have a financial planning software, and some of these are in there. But then again, like as retail people,
Right.
like you're not able to access them. So I have access to financial software, but
Right.
not everybody does. But let me see if I can find the tool and then you
I
may
mean,
be
getting access to it through someone like yourself, who it's a paid service, so there's no other additional gaming going on. It's, that's, you pay a license and then you provide it to all of your
yes.
clients. That would be
Yeah, it's
good.
less biased, right?
Right.
Like it's not a specific insurance provider creating a tool and So yeah, that may be allowed, like if you have an advisor.
I mean, even just signing up for, Medicare, I get Medicare, Medicaid, except but whichever one,
Or Medicare.
Medicare. And, it's so freaking daunting. Um, that, you just don't know. So having a reasonable resource to refer to help in a big asset.
Let me see if I can find some free resources, and if I do, then I'll share them. Like some Excel files.
Excuse me. May I have a better view of the screen, please?
Oh,
You don't have to sign
Oh. That's my fault.
Selected.
Thank you.
take this for Excel.
Missing something. No.
Thanks.
Sorry about that. If you choose to work with a financial advisor like yourself, is that typically something that they will advise on? Is long-term care insurance and those types of things? It can be comprehensive, yes. So insurance discussion is part of financial planning. So there are different kinds of financial advisors. Traditionally, financial advisors have focused on asset management and charging a percentage of assets under management. And they don't really go into all these different discussions about like longevity or insurance or planning. So they say they're a financial advisor, but all they do is investments, right? And so a comprehensive financial advisor or financial planner should be able to provide all these different services where they talk about all these aspects. Okay, thank you. So I'm going to share some resources at the end. Too.
So the other question I had was went back and looking through the different mutual funds we have and things like that for the fees. And so the one thing I saw that I was a little confused about, right? It had a total fee, but then it had the I forget the term. It had like 0.02% for the fee, but then it said a management fee of 0.02%, and I wasn't, and the total fee was 0.02%. So it was like all the same. I was trying to figure out management fee and the.
So they have a number of fees that get added up, and there's a number called the net expense ratio.
Okay.
So that includes everything. And sometimes they offer some discounts. So the net fee may be slightly lower than if you took all the other fees and added them up. Good. No other questions? Good. So yes, withdrawal strategy. So one of the very common strategies, the 4% rule. And if you use that, what that does is the day you retire, let's say I retire with $1 million, the rule tells me that I should, in the first year of retirement, withdraw 4% of my assets. So that's $40,000. And then every subsequent year, I increase that amount by the rate of inflation. The problem with that rule is in the initial years of retirement, if the market returns, so however your portfolio is structured, whether it's like a 60-40 portfolio, 60% allocation to stocks, 40% to bonds, or 50-50, however that is. If the market is down for the initial period in retirement, then you are sort of withdrawing out of that asset size, and you don't get a chance to recover from it because you keep on drawing more and more out of that portfolio. So there is a dynamic withdrawal which tells you to reduce your withdrawal when markets are down and increase your withdrawal when markets go back. So this is slightly better than the 4% rule. But again, like you have to sort of set certain thresholds of what it means by market going up and how much I'm going to cap your withdrawals at. So third one is the bucket strategy, which I like, and it has its advantages, and we will go into some of them. There are cases where it doesn't work. So in that strategy, you divide your assets based on the time horizon. So you have your now bucket, which is for expenses you're going to incur in the immediate term. Then you have your soon bucket, which includes assets that will support you in the intermediate term, and later bucket, which will support you for longevity. And like these are the assets that will grow. And what happens is over time, you start moving money from the later bucket into the soon bucket into the now bucket. So the now bucket, it includes anything that is cash or cash like. So your savings account, your checking account, high yield savings, money market, anything that can be quickly accessed for cash. You don't need to sell it, or you don't have to worry about what the market is doing. And that covers your spending. Again, like these, the term, the 1 to 2 years, it's up to you and your risk tolerance and your goals. So this covers your immediate financial needs. Just one thing to be cognizant of is any accounts that you keep your cash in, like if it's a bank account, make sure that the bank is an FDIC member. So what that does is your assets are protected up to a certain threshold. Typically, that's $250,000. So let's say I have a checking account and a savings account and a CD at Bank of America, and the total is $300,000. But because Bank of America is an FDIC member, my assets are protected up to $250,000. So if I want to keep 300 in cash, I would take that 50 and put it in another bank. That way it is protected. And if you have like an individual checking account with the bank, and you also have a joint account with your spouse, then those are considered separate. So you have $250,000 protection for the individual account and then $250,000 for this joint account. And similar thing for credit unions. So there's something called NCUA, National Credit Union Association. So it's like similar to the FDIC for banks, but this is for a credit union. So if you bank with a credit union, make sure that your credit union is a member of the NCUA. That way you are protected.
Would credit unions, do they only have the NCUA or are they eligible for the FDIC?
I think they're part of the NC. I'm not sure if they can be both.
Now, are the SIPC limits the same for like the stuff that's in your stock
No.
account?
SIPC is different, and what that does is, so it's not protected up to a specific limit, but if you own different stocks, then SIPC would potentially make sure that you are made whole on those holdings. So they cannot guarantee, let's say I own Apple for $250,000 and Apple goes down to 100,000. SIPC does not protect me for that 150,000 loss, but it will protect me for the number of shares of Apple that I should.
Or what about the cash balance that's sitting
And the
there?
cash balance, yes. But I don't know if there is a limit. Like maybe there is, but I'm not aware of it. So like with the Silicon Valley Bank failing, if you had up to 250,000, then that would be covered by yes. The next bucket is the soon bucket. And this is for income in the intermediate term. And again, this is just a guideline, like 3 to 7 years. It could be 5 years, it could be 10 years, depending on your risk tolerance. And what one would include in this bucket is something that can, I should not be using like the word guarantee, but create some kind of a reliable income stream that you can live off of. And so one example is creating a bond ladder in this bucket. And I'll talk more about what that is in a little bit. So this kind of, creates this stability and peace of mind for the intermediate term, where you don't have to touch your stocks or equity funds in the intermediate term. And then the later bucket, this includes stocks or mutual funds or ETFs. So anything that can fluctuate over time. But you don't want to sell out of this bucket when the market is down, because then you convert paper losses into permanent losses and the value is gone. And what this bucket does is it hedges your portfolio for longevity risk and growth. So if you have goals later in life of maybe travel or passing your assets to the next generation, then it helps those assets. So when markets are up, you would sell a little bit out of the growth bucket and move it into the soon bucket. So later to soon. And okay. And when markets are down, you don't touch the later bucket. You draw out of cash. And that way your portfolio can weather the uncertainty storm of the stock market. So this is how it may work. So if let's say we are here at the bottom of the ladder at year 0. So at year 0, I could potentially buy bonds that mature in year 1, year 2, year 3, year 4, and year 5. So today I have 5 bonds, each maturing in a different year. And I have my I have my cash bucket, which I can use for this year's expenses. So next year in 2026, I reach this point, and anything that matures in year 1, I can now use for my expenses. And now I only have 4 runs remaining, 2, 3, 4, and 5. So at this point, I can choose to buy 1 more bond and create an additional run in the ladder. Now, if the market is down, I don't buy anything, because I'm going to buy using sales proceeds from the later bucket, which is all stocks, right? So if market is down, I don't need to do anything. I can leave it like that. Then come year 2, I use anything that matures in year 2 for my expenses in year 2. And I still have 3 runs remaining. And at this point, if the market has recovered, I can buy 2 additional runs of the ladder. If the market has still not recovered, I can wait it out. Move to year 3, and I still have 2 more runs. So if the market does recover at that point, I can sell some stocks and buy bonds. And that's how the bond laddering strategy works. So there is no panic selling because you need income immediately for your immediate financial needs. And you have steady income flow from your cash bucket and from these maturing bonds. Any questions?
So it bridges you over a market downturn. It gives a couple of years for the
Yes.
market to recover. Okay, so you're always interesting.
And depending on how many runs you have, you're set for those many years.
So those bonds are a set amount, that can't change. If you,
As long as you hold them to maturity,
okay,
the proceeds are not going to change.
they're guaranteed.
Depending on the issuer. So if the issuer is bad, they go bankrupt, then you don't see your money.
So you have to be careful.
You have to, yeah. So treasuries kind of safe, like so far they haven't defaulted.
Yes.
So with treasuries, one can say that with a certain probability, high probability that you will receive your money in the year that the bonds mature.
So you're basing that amount that you, that bond is for on what you estimate your annual cost is. It's of its living cost of living. Your own personal expenses.
Personal expenses. Exactly. And you could use different kinds of bonds, like it could be a single maturity bond, it could be a bond fund, it could be something called strips. These are treasury vehicles. I use them a lot in client portfolios. And these are treasury instruments, but they have a single maturity, and most bonds, like long-term bonds, they pay interest every 6 months. Strips, they don't pay any interest. They pay one lump sum amount, so that which includes the interest at the end of the term.
So might this strategy get a little tricky in a prolonged recession? Wouldn't
Yes.
that interrupt your laddering?
It would. So, and I will talk about that
Okay.
next on the next slide. But this is what the data tells us. So I went back almost 100 years to the Great Depression, and it shows you when the S&P 500 peaked, when it bottomed, when it recovered, what the maximum, like how much value it lost. And then the months it took to go from the peak to the trough, and then again from peak to recovery. Okay. And what I have listed, so there have been many recessions during the last 100 years. What I have listed is all the periods it took the market longer than 2 years to recover. So this last column, longer than 24 months. And what I've highlighted is recoveries that took longer than 5 years. So if I were to do a bond laddering strategy with 5 bonds, like bonds with 5 different maturities, then this kind of fails because it took longer, right? So 81 months, 64 months to reach that same level as before. But what's the alternative? Like the 4% rule is probably going to do worse than this strategy.
But one of the things to think about though is the trough. It has, even though it took to recover to where it was, it
Yes,
still recovered
it's
some.
still, yeah,
after
exactly.
the trough. And
So-
in that case, it was always, except for the Great Depression, 2 years.
Yeah.
Okay.
And so this is when this strategy can struggle. So if there is like low return environments, if you have a large cash allocation and inflation is really high and you can no longer afford the items of daily necessities, then you would have to go to your stock bucket and sell. Panic selling, like nobody can save you from that. Like you have to be, think rationally and talk to somebody you trust to prevent yourself from self-sabotage. So yes. So the goal is to make your money work for you and not outlive it.
So the key thing with that strategy is lets you keep money with a degree of confidence in the high return but higher risk investments that
Yes.
over the long term have shown to grow more
Yes.
without having to be concerned for the near term.
Correct. And some people may not need that growth bucket. So let's say I have $10 million today and I can survive on $500,000 a year and my longevity is 10 years. If I don't care about leaving a certain percentage to the next generation, I could keep all of that in cash and live off that cash so that the need for risk goes down because I have a big asset pile, which I don't, but I could. So yeah, that's so depending on your goals, risk tolerance, like those are the main concerns, and your spending. You may or may not need the 3 months, but I think it's a great strategy because it gives you a lot of peace of mind, and you don't have to worry about selling. If you have, let's say you have a 7-year plan, you don't have to worry about the stock market for 7 years. So 4% versus bucket strategy and how the risks, what the different risks are. So sequence of returns, we talked about that, right? Like if early in retirement returns are negative, then your portfolio, like the chances of outliving your assets go up. And that's really high for the 4% rule. But if you've set these buckets for the next, 5, 6, 7 years, then that risk goes down for the bucket strategy. Then inflation is kind of moderate with the 4% rule. But if you have a lot of cash and there is high inflation, then that risk goes up. Behavior. Imagine like you needing to draw out of your portfolio every year, at least 4%, then it can really drive up your stress because you have a certain asset size and you need to liquidate part of it to support your living expenses, and it goes down with the bucket strategy. There is longevity risk, and it lowers with the bucket strategy. However, it can be complex because you need to do this every year, building new runs as the current runs start to mature. So, time for exercise. There is the first page is your budgeting worksheet. You can skip that. What you could do is you plan your income. So step 1 is to determine what your monthly income need is. And if you have an idea, put that down. I don't know, pens or a pencil.
I have a couple. Three. You want to do me?
Right. It's one. It's called a bucket strategy exercise.
Everybody want pencil? It starts, it's two pages.
Yes.
What is this, the audit checklist?
Oh no, it's the bucket strategy.
bucket.
It's the second, yeah.
Oh, okay. There's two.
There's 2
side,
pages.
first page.
Yeah, the first page is and it's front and back. So the first page says income planning. So if you have an idea of what your expenses are in terms of needs and wants, you could list them there. But I also have this budgeting worksheet, which was the first page. And this is an exercise I like to do. The first time I did it for our expenses, I was very surprised at where my money was going. So it categorizes your expenses into 8 buckets, starting from housing, which is like it could be a mortgage, rent, homeowners insurance, so anything housing related. And it's pretty steady, right? Like those expenses don't fluctuate a lot. The second bucket is utilities, so gas, electric, cell phone, internet, so on. Those are also kind of fixed month over month. Then the next one is transportation, if you have car payments, fuel, maintenance, etc. The next one is credit cards, student loan, any debt. The fifth one is education and training. So maybe Chesapeake Forum and the amount you spend here can be included. Book supply. So for me, education and training is kind of non-negotiable. So that goes in my non-discretionary bucket of expenses. Then savings, if you're still contributing to your brokerage account or savings account, so that would go in the next one. And what I would recommend is going to that and downloading an Excel file. If you want, I can send it over to you later. But if you go to wealthwiser.com and budgeting template, you can get an Excel file. And what I do every year is do a data dump of all the credit card bills. So you can set filters. So starting January 1st, ending December 31st. And download everything in an Excel file and start categorizing all the expenses. If you don't want to do it for an entire year, you could do it for 1 month. The reason to do it for a year is because like you may incur some expenses at certain, during certain seasons. So like we travel during summer when my daughter is out of school. So you wouldn't see those travel related expenses in November. Or gifts, Christmas gifts, like you won't see them in summer. So I do it for the whole year and then do an average of expenses. Then the next one, actually I'll go to the next. So this is what it looks like if you download the Excel file. And then it'll give you a breakdown of where your money, which category your money is going into. Then there is non-discretionary, which includes groceries, any dependent care, insurance, medical bills, etc. And then the last category is discretionary expenses. So anything you spend on eating out, movies, hobbies, your Netflix, Amazon subscriptions, and so on. And the reason for doing this is you will get an idea of what your income needs are, like what's your monthly income need. Then the next part on that budget strategy exercise page is determining your reliable income sources. So again, like I held myself back from writing guaranteed income sources because who knows if Social Security will be around. I mean, I'm sure it won't be around by the time I retire, but at least for now it's available. So you would include Social Security, any pension income, any annuities, rental income. If you're doing any part-time work, then I would add all that income. And to create your total reliable income. And then step 3 is to calculate your income gap. So anything that is not covered by your reliable income sources is what needs to be generated from your investment. So once maybe I'll explain you the whole thing and then we'll take a break for you to fill that worksheet. So the next part is to start filling your buckets. So if you know where your money is, you can determine how much is kind of in each bucket if you have that allocation. If not, try to determine what your target amount looks like. Even if you're not going to use this strategy, just for fun, like maybe put it down on paper. Like what you think should be in your now bucket versus in bucket versus later bucket. And then try to identify what kind of accounts you would like to use for each of them. So I have example accounts there. You can circle, and this is for you, you're not going to share it with me. But circle what kind of accounts you'd like to use for each bucket. And if there are accounts that are or investments that are not listed in example accounts, you can write your one.
So if you were planning like 3 years from now, an anniversary, and you were going to do a big, expensive trip.
I'm not sure I understand.
Yeah, I don't understand either, sir. So in year 4, you would allow for that. So say your normal expenses are $50,000 a year, but you're going to do this $20,000 trip in year 4.
Yes.
You would make that $7,000 or $7,000.
Yes.
Okay. Okay. So personalize it too.
Yeah.
Soon you plan that far ahead. Can't remember my anniversary date at that time. 3 years.
Doesn't mention it here, but in the ladder bond strategy came out. That was in the student bucket, right?
Yes.
So if you take into account things like going out in years, you say that you need so much in your 1 to 2 year bucket, say $2,000 a month. But as you go out in your 3 to 7 years, you increase that for inflation.
Yeah. Yeah. You've done.
But then you can look ahead and figure out, all right, the later years, I'm not going to travel as much. There's other things I'm doing. You're doing less of.
And typically in later years, it sort of balances out because your medical expenses get higher in later years. And early, like in the go-go years, it's more travel than or helping adult children if that's the way it goes. Monica, any thoughts or questions?
No, except that I'm thinking I need more money.
Big club. Come on.
Your examples of 1 million or 4 million, like, yeah,
I know,
really is it now.
10 million.
So I'm lucky to have a pension. That's the game changer.
Yeah, the insurance company that I work with, they used to give pensions, and then at some point they stopped it for new employees. But I know that once I reach 65, I'm gonna get 600 a month. So and it's not adjusted for inflation.
That's
So
right.
I know exactly how much I'm gonna get.
Yeah, I worked for IBM 17 years, and then when I left, I had, when it was a term for it, that I had accrued some kind of a thing, so I get a certain amount each month. It's nice. Pays for going out to dinner once in a while. Probably glad.
Depending on where you go.
Right. You do a little bit of, can't do the wardroom, a little better than McDonald's.
There you go.
Probably got it. But the later bucket's harder. I mean, that depends on how you want to live and that kind of stuff. Right?
Yeah. And some of it is also dependent on genetics. Like if your parents live long times, it's likely that you're going to be one of those people
Right.
that lives on.
Keep making medical advances.
Yeah. Give you 1 more minute, and then the last page of that exercise is just like reflection on how large each of your bucket is. And you may not have an idea right now, but when you go home and look at your portfolio, you can take stock of how where you are, how you feel, which bucket is over or underfunded. Some people are really conservative and not big risk takers and like to keep a lot of cash. So it's a good exercise for just self-awareness.
And if you do for ladder, you do it on an annual basis, like a 1 year CD, 2 year CD, 3 year CD versus monthly.
Yes,
You know,
because then it
so-
gets complicated. Like there's no need to add extra complexity. Like everybody is busy, you want to enjoy life, not worry about finances. So 1 year is perfectly fine.
But you gotta plan your cash flow.
And which is why I think it's important to keep that emergency savings. So that 1 to 2 year also includes your emergency savings. Like if something were to happen to your roof, or you need to buy a new car, your car breaks down, like are you able to cover that expense? And a good way to save for emergencies is through high yield savings accounts. So these are not your traditional banks. They're typically these online banks with lower overheads and they pay a slightly better interest rate. So something like an Ally Bank or Marcus, which is a golden bank, Wealthfront, and just make sure that they are FDIC.
And you would just buy CDs through those online banks?
So they're called high yield savings.
High yield savings. Okay.
Yeah. So three characteristics. So one is that you want this asset to be highly liquid for emergencies.
Mhm.
You want it to be accessible,
Mhm.
but you don't want it to be so accessible that you use it to, eat out or buy Christmas presents. That's not an emergency. And then save, like FDIC.
What interest rate is considered high yield?
It changes based on how the Fed changes rates. So you will see a certain. So my emergency fund is with Marcus, and I'm not like promoting them or recommending them. You can do your own research. But at that point, they offered a slightly better rate. But all these different banks, they are very competitive, and so one may offer a higher rate today, and then somebody else offers a higher rate a few months later. And people do that. They will then withdraw everything from this bank and go to this other bank, and I don't like that hassle. So I have been with Marcus for a long time. Like that's the first emergency fund that I created, and I've been with it since the beginning. But yeah, so there is like these rates. At one point they were giving 4%.
That's what I was thinking, it was about 4%.
Yeah, but then it came down. I think it's at 3 point something percent right now.
It'll probably go down again today on the Fed.
Fair, yeah.
Right. They lower the rate.
Yeah. But no matter what these banks have in the past offered better rates than Bank of America or Chase. And then they are out of sight, right? Like they are with an FDIC member bank. And I know if there's an emergency, I can go and access these funds. Okay. So let's move on.
Well, a lot of times too, with that, your cash balance that's with your brokerage account, like that's even offering higher right now than the online banks.
Yes.
And
like
then
the
it gives you the
money
flexibility too to move it between bucket 1 and 2 easily.
True, yeah, they do, they have been offering, more, but again, like that also fluctuates, so it's not gonna stay at that.
Right.
So I wouldn't use it for bucket.
No, you bucket one. It's
Okay.
usually about 0.5% higher than the online banks.
Sorry.
But that's, well, I have my high yield is Citizens Access. But the money that's in the Fidelity brokerage account makes a little bit higher.
Oh,
The cash that's just sitting there.
yeah, Vanguard's doing about 4%.
Yeah, that's about the high end right now.
So the next topic is tax. We don't, like, a lot of retirees, when they come to me, they're very surprised by the tax bill in retirement. So let's talk about location. So we talked about allocation between different buckets and different kinds of assets. But your asset location also matters. So somebody starting to work in their 20s may start at a zero net worth or negative net worth, depending on how large their student loans are. And eventually they start to accumulate assets. So I like to break assets into 4 buckets. The first one is your tax, which is this one. And it includes your checking, savings, brokerage account. So anything that is generated, any income, any capital gains that are generated in these kinds of accounts are taxable in the year in which you get that money. The next bucket is your pre-tax bucket. So these accounts are tax deferred, which means the IRS hasn't taxed anything that went into this bucket. So your 401k, IRA, 450, 457 accounts. The next one is your tax-free account, which is your Roth IRA. You've already paid tax on the contribution that went in. So your HSA, your Roth IRA, and so on. And then the final bucket is your real estate. So any investment properties, your primary residence, cars, jewelry, all of that comes from the real bucket. And these are typically the last assets to be liquidated. Over your lifetime, this allocation changes. And generally, not always, but generally your pre-tax accounts become a significant portion of your overall portfolio. And while we view these accounts as assets, the IRS views them as future income waiting to be taxed. And so let's look at the case study. So this is George and Martha. They are 72 and 68. They have a net worth of 7 million. And we've made some assumptions for them. So longevity is 95 years, inflation is 3.5. And we've assumed a rate of return for like the overall portfolio to around 6%. And they need a certain amount each year. So based on these assumptions, their net worth is expected to grow to about $25 million over their lifetime. But the real challenge, I think this thing is getting cut at the bottom. I didn't realize that. Anyway, so this shows the tax bracket, like the projected tax bracket over the years. Okay, so the horizontal lines show different tax brackets. For example, the bottom pink, I think it's pink, but the bottom pink line is the start of the 10% tax bracket. Then the next line, the teal line, is the 12% tax bracket. The orange line is the 22% tax bracket. Then there is the blue line, which is 24%. Then 32, which is this line, 35 and 37. So because they are retired, they are in that low tax bracket. So they are in this zone. So their income puts them in the 12% tax bracket. They haven't hit the 22% tax bracket yet. But next year, George's RMDs will kick in. And that will increase their income and put them in the 22%. So they are going to almost fill that entire 22% tax bracket. And then eventually Martha will. And then they will cross this, they will be in the 24% tax bracket. And as time progresses, given their assumptions, they will, be in the 32% tax bracket and then eventually go on to the 35% tax bracket. So this is sometimes unanticipated because retirees assume that, I don't have income, but the required minimum distributions from the 401ks and IRAs or inherited IRAs in some cases, they put you in a higher tax bracket. And there are certain strategies. So over their lifetime, they're projected to pay about $7 million in taxes, and their assets would go up to about 26 million. Now, if they did a little Roth conversion so that they fill that 22% tax bracket this year, that will bring their lifetime taxes down. So it'll be 125,000 less over the remaining lifetime. And it will also, actually, I should not say it will, but it is projected to add about $732,000, given all these assumptions. It's not going to happen because all these numbers are going to be wrong. But directionally, it gives you where the portfolio may go. And if they do more Roth conversion, they're a little more aggressive in their Roth conversions, and they fill that 24% tax bracket, it brings down their cumulative taxes significantly. So over their lifetime, they pay $2 million less in taxes. And portfolio assets at the end of lifetime also. So if that is one of the goals, then you may want to start thinking about Roth conversions. I said that this is not an ideal strategy. Like I cannot apply this generally because it depends on what your goals are, first of all, but also in some cases it can increase your life taxes. So don't take this and just say I'm going to convert my entire portfolio. So if you did that, pay a lot of taxes today and not really reap a lot of benefits over your lifetime. So that's one thing to think about. Yeah. Any questions?
The tax, in what point in 45, 7 or so, it takes a dip. The tax rate's lower.
They actually go up, right? So this
Oh,
is the
right, I see, they go up.
George taxes.
Oh, okay.
And there's the widow tax. So then Martha would file as a single filer. And then tax rates are not as favorable for single filers as they are for married filing jointly.
Okay.
So then now she is like in a higher tax bracket. So lower income but higher.
If she's got a lot more Roth money that she can draw from tax free.
Yes. Yeah.
Well, and another reason that I know I watched the tax bracket plan that there's also the IRMA charges on your Medicare. Because
Yes.
those tend to be pretty close to the tax brackets.
They can. So with IRMA, the thing is, if you cross a certain threshold,
Yeah.
it adds a surcharge. So if you're
Right.
very close to that threshold, then I'd rather keep you under that
That's
threshold.
right.
But it's a small price to pay in some cases. The IRMA surcharge may be a small price to pay if the lifetime tax benefits are good. And IRMA surcharges, oh, sorry, did you have?
What is Irma?
I don't remember the full form, I should,
But-
but it's an acronym, IRMAA. So your Medicare premiums that you pay are dependent on your modified adjusted gross income. So your adjusted gross income is a line item on your 1040. So depending on the 1040 that you filed today, your Medicare premium is going to be determined the following year, how much it is going to be. So if you have a high AGI, then they will add a surcharge to your Medicare premium.
When they consider high, what's the,
I don't recall of
I
the
mean, are we
number.
talking like?
190 comes to mind, or 170.
Yeah, I don't have the limit.
You
I'm
can
fine
find
with
it.
that.
You need to find it.
I won't ever have.
Is that individual or, if you're filing jointly?
So there is both. Like both of you would have to pay a certain surcharge because it's a joint tax. But sometimes it may be a small price to pay to get your lifetime tax benefit.
What is the rough conversion? Sorry.
So you have these pre-tax assets, right? They are actually call them pre-tax, but they are tax deferred. So at some point, when you start making withdrawals from your 401k or IRA, the IRS will tax that entire amount, and the amount it's going to be taxed as ordinary income, not as a capital gain. Okay. And you can do it at any point. Like you could take it today, or you could take it 10 years from now and make a conversion. So you can withdraw from the 401k and put it in this Roth, like the orange, the tax-free bucket in your Roth IRA. And you pay tax on the withdrawal. So that's the Roth conversion.
But when you take it out later, you don't pay.
No, you always. So anytime you take money out of the 401k, you pay tax on it. With the IRS, right? Like they don't allow you to carry these assets into perpetuity. After you reach the age of 73, you start taking required minimum distribution, the RMDs. And those are based on your longevity and not your longevity, but what the IRS decided your longevity is going to be, and the size of that account on December 31st of last year. So that's the amount that you need to withdraw each year.
So you're forced to draw it. You have no choice.
Yeah. You have
So you're-
and there are
You're
penalties.
going to get taxed on.
Yeah, and if you don't, there are penalties. And then, let's say I have a large 401k and I die, and if my spouse inherits the IRA or 401k, he can treat that account as his own and start taking required minimum distributions using his longevity and the size of assets. But if both of us die and my child inherits it after the age of majority, let's say she's 18, she inherits it, she has 10 years to zero out the. So then, like, she has to pay taxes on it. But if it's a Roth account, you still have the 10-year limit, but you don't have, nobody has to pay taxes on it because you already paid taxes. Everything. Thank you.
So quickly on the IRMA bracket, so the 185 standard Medicare, that's up to 106,000. That may be individual, never mind. But yeah, I think it's a little more for married jointly. But then it goes up like every 30 or 50,000. Pretty soon it gets up to, 250 or 370. So that's one good one to keep in mind.
Well, and I know, like, since my husband's still working and I'm under his insurance, even though I'm going to turn 65 in March, I'm going to sign up for Medicare but not take it. and I'm not going to take it as long as that. And, but I don't really I've been told you have to sign up.
Well,
Yes,
confirm
sign
if your
up.
husband's insurance will let you stay on it.
Oh, yeah, yeah.
Because some companies don't. Some companies,
As long as I don't take Medicare, I can be on it.
okay.
So you get the health, because I did that too. I'm older than Cindy, but she was still working and I retired and I stayed on her health insurance. And you have to sign up and you actually get the health or the hospitalization isn't free, is included. But you don't have to pay anything and every year you have to tell them that you are on another,
Okay.
You might have to,
and then you
There's
don't
a
pay
form.
anything.
you would have to file with your income tax, just stating that, you were covered by.
And then when he retires, you get about, I think, 3 to 4 months beforehand, you can tell him you're going to do that. And then,
Right.
because it takes them a while to process.
Well, we're really lucky because he's with Carolina County Schools. And after you've been there for 15 years, after he retires, we both still get insurance for 2 more years.
That's great.
Oh, wow.
It's part of their retirement. Should be awesome. Then I think by that point, I'm 7.
Okay, here, married filing joint was 212. So if you stay under 212, then you won't get any charges, married filing joint.
Okay, cool, thank you.
No problem.
Okay. So let's talk about estate planning a little bit. I'm not a lawyer, not an estate planning attorney, so I'm not going to give you any legal advice. But this is more from a planning perspective, some education. So three things. So if you consider your legacy as like a house, then your values and giving, like that's the foundation. Your documents on an organization, that those are the walls, they add structure to your plan. And then protection and control is like the roof of the house. And many people like minimize values over money. Like money is not the only thing that you leave to the future generation. I think setting values is very important. And I haven't seen these studies personally, but like in the financial advisor circle, which I'm very active in, we often talk about how one generation earns a lot of wealth, and then because they have earned it, they value it a lot, and they don't spend a lot of it, and then the next generation gets to spend a lot of their wealth. And by the second generation, so 1 to 3rd generation, the wealth is gone. And so it's so important to pass these values of frugality or just money values. It's so important to pass that. And you may have other things too, like being part of this forum, mentorship, not just giving money, but your time to the community, family and causes like that. That is so important. So, like, think about this. If your wealth could tell one story about your life, what would you want it to say? So that's something that I often think about, like just about my own legacy. I talked about it to my parents and I grew up in a very middle class environment, so a lot of what they gave me were values which I really hold very dear, cherish. The next part is your documents. So you have on your desk is this beneficiary audit checklist. And you can use this to sort of organize your estate planning documents. So list every account. So there are 2 ways your assets can be transferred to the next generation. One is through a contract, and then the other is through probate. And so the accounts, some of the accounts that are up top, your 401k, your retirement accounts, your insurance policies, that is all through contract, and you can list the beneficiaries. And the beneficiary listed on the account supersedes a bill. So you may have your ex-spouse as a beneficiary and you forget to change it on the 401k designation. And your bill says your current spouse gets everything. Guess who gets it? Yeah, the ex gets everything from your 401k. So it's really important to, go over, review these from time to time, at least once a year. And if there are any life changes, I'm going to go in and make sure that the beneficiary listed is the intended beneficiary. For brokerages, there is no beneficiary, but there's something called transfer on death. There's a form that you need to fill with the bank. And the credit union, they also have like something called pay on death. So that's different from a beneficiary designation. And then make sure that all the spellings, legal names are correct, or the percentages add to 100, and you have both primary and contingent beneficiaries listed. You have their social security, contact information current. And then step 3 is to review for life changes. Yeah. And then coordinate with your estate plan. Make sure that your will states the same thing as your beneficiary designation. So I would make a list, but keep it in a safe, secure location. You don't want to put it for everybody to see. Like, even your digital assets, like how to sign into your bank accounts and different accounts, and review them. There are some online options available too, but I'm not gonna promote any specific name because I don't know the details about it. But my husband and I, we shared our documents through Dropbox right. And then the next one is a legacy binder starter kit. So make sure you have all these documents stored somewhere. And then one person has access or knows where to find this one document in case something happens to you. You don't want it to be in your safe deposit vault with nobody having access. Yeah. No, I think that's it. That's all I. And yeah, any questions?
Just going back to, once again, in some investments, mutual funds and things like that. So right now, if you look at, so we were looking at Cindy's mutual fund where her 401ks invested. And it turns out that the top holding, it's at 500 estimate, and it's got a very low fee. But the top holdings was NVIDIA, Apple, Facebook, Amazon. I mean, it's all the AI stocks. It's like, wow, that's kind of.
Yeah, you almost don't have to invest in those separately because the S&P is so heavily weighted with the big stuff in there.
Yeah, exactly. So I'm thinking, like, man, is there a mutual fund that takes out the top 10 and goes to the next ones? I mean, I guess, it seems overweighted in that. And historically, I think it's unusual. The S&P has been so heavily. I mean, because there's 4 companies now worth $4 trillion. It's crazy. And so I lived through I was in the telecommunications industry, and when in the 90s, the late 90s, they laid so much fiber optic that it would have taken 100 years before we would have ever used it. Crazy. We went crazy. And I worry that with the AI thing now, they're kind of doing the same thing. So, all right, maybe it's time to balance away. Are there, you look at like Morningstar or something like that that helps rate mutual funds and give you a feel for those things. Are there some ones that consider, well, you had shown a chart, I don't know if it was last week or the week before, where it showed the cyclical thing.
Yeah.
And, like utilities, everybody's going to need electricity. Everybody's going to eat groceries. Everybody's going to need medicine. Are there some that still have some growth, but
So there are sector ETFs which give you exposure to specific sectors, or 10, 11 or 12 different sectors. And each of these ETFs gives you exposure to specific sectors. So I don't know the ticker. So I know one, BDE, which is a Vanguard ETF that gives you exposure to energy. And there are others like for specific utilities and
Aren't they opening up like water now too? Water.
TG.
Yeah.
So TG is a good AT.
and so there are
Pays over 8% dividend.
UTG.
UTG is a utilities ETF.
Okay.
Yeah, because the utilities pay dividends. That one pays over 8% right now.
well,
And it's continued to go up too. Some of them that pay high interest, they tend to sink a little bit as they pay out capital, but that one has done well over the last few years.
So something like the sector ETFs.
so sector ETFs.
Yeah, they talked about the AI bubbles. It's a little nerve wracking.
Yeah, I mean, I own some NVIDIA stock, but done really well. But at some point, like I said, the fiber optic thing, we went insane about it, and we seem to the same thing with real estate back in 2007, 2008. It was crazy what was going on, and of course, then we went and tore down homes after it, and now we have a housing crisis. We don't have enough homes.
It's all cyclical, right?
Yeah. Of course, you just never know when the cycle's going to hit.
Yes. Yeah, the thing with the S&P is that even though it is overweighted, like if it's kind of self-cleansing, right? Something else comes up, it'll get added to the index, and probably don't have to worry about adding it yourself. If you want to get ahead of it, then maybe buy it.
It just seems like, years ago, there were a lot more smaller public companies. And with the consolidation and mergers and acquisitions, and I mean, I used to do M&A. I mean, do M&A, you want to wring money out of it. That's the whole goal. And that doesn't necessarily leave a robust company. I think of like Toys R Us. It was interesting what happened when they bought Toys R Us. Toys R Us was worth a lot of money because they owned their stores. So they had all this real estate. And what they did was they went and sold all the real estate, took all the money, and paid the equity investors that put up the money to buy it. So they made a ton of money. And then they left the company that now had to pay rent on all those properties, and it quickly went bankrupt. And then people lost their pension and things. And Toys R Us actually was a pretty good company, took care of their employees and things like that. And so it went from a robust, safe company to one that they found a way to milk a bunch of money out of it and destroyed. Now you kind of worry, like, are there the model used for stocks for the last 100 years has worked really well, but you want the foundation underneath it still hold. Because some of the things that we've allowed to happen, and then releasing some of this current administration's approach is to relax some of the controls, which kind of people, smart people figure out ways to make money by taking advantage of the controls, right? So, yeah. But yeah, sector ETFs. And,
Well, oh, go ahead.
no, it's,
Is it worthwhile considering a low-cost index fund than investing in certain sectors, hoping that they'll do well and then having to keep an eye on them all the time?
I would diversify just because there's no way to tell which part of the cycle you are in or what's gonna happen. And no, it's harder to keep. And which is why I like that bucket approach because you have stability and then you don't care what happens in the stock. I mean you do care in the long run, but and in the over the long run you want it to go up. But in the short run you're not too concerned.
Yes.
so that's interesting. So it would be interesting to have, because the S&P used to be pretty diverse in terms of its mix because no one company was so huge. But if there's like an ETF or a mutual fund that doesn't let any one company dominate it, so that it is really, the funds are diverse, that would be interesting.
So there are different indexes, right? Like the S&P 500 is a market weighted index. So each company in the index weight is proportional to its market cap. So the larger the company, the larger the weight. But there are different weightings. So there are equally weighted indexes. There are some one or two different ways in which. But again, I'm not familiar with which ETF or fund follows that index, and I can look it up and let you know.
So one interesting thing I read about Warren Buffett in 2008. I don't know if you've heard of this, but he challenged all these hedge fund managers, made a bet with them, and said he would invest for 10 years. He would just put all his money in the SPY, which is the index fund for the S&P 500. And he challenged anybody to beat his return. He's just going to go straight SPY. And he beat everybody for 10 years up through 2017. So if you're not really into investing and don't love searching for that great next stock, just investing in the SPY is probably going to give you, solid return. And if you look at it over 10 years, it's like almost 20%.
Yeah.
But see, and that's what I have done pretty much. My concern is, like I said, when we just went,
Yeah, it's overweighted for those.
Now it's gotten so overweighted, and I think it's interesting. I mean, they can't sell their chips fast enough, and people are paying for it. But NVIDIA is taking investments in a lot of these other companies because they're $4 trillion valuation. They're using their access to cash to invest in other things that are buying their chips, which, are they making their own market? And when does that fall apart? And it's kind of like in China.
Kind of a self-licking ice cream cone.
Well, yeah, it's like when China was set up with the housing thing, where they were building housing way beyond the number of people they had. And now they've got these huge buildings sitting there empty. And they don't have the housing crisis we have, but just the opposite. They got all this excess. And people tend to go to these things. And so I'm thinking, I believe in the market and, capitalism, but how do you avoid it? But that's interesting, the different weighted funds. So you can get one that's weighted less on market cap, because I think it's the market cap that makes you nervous.
Yeah.
I'd rather own more of waste management. Everybody's going to have their garbage.
But then again, it's not really the potential of it, not like it may be a stable company and it will generate dividends, but it may not grow as much. And then
Right.
if you compare this with the S&P, then
Yeah, I mean, I guess it depends to some degree whether you think, and I know you and I've had this conversation. There's a bubble and it's going to burst.
you don't know when.
and you don't know when, but we're getting closer and closer and the controls are going up. So in engineering, there's a systems theory about how much you regulate, you can keep things in control. And remember feedback on a microphone? Well, that's because you take off some of the regulations and it feeds back and it blows up. Well, it works in human nature too. And so at some point we're getting close, and I'd rather maybe take more modest growth and get through it because I think I'm more likely to win. But you also don't know how big the downturns.
Yeah.
Like in 2000, right, the dot-com, it went in half.
Yeah.
And but it came back, and I didn't sell my stocks and I didn't sell my mutual funds. But and it came back, but I was a lot younger then. And I was still working, right? And I'm a lot older now, and I'm already retired. I'm not making any money. And so, yeah, so the dot-com bust, yeah, 46%, yeah. 'Cause I remember my S&P fund, it almost cut in half. And there was this woman I worked with, and about 3 weeks before, she got nervous, she sold it.
Oh, wow.
Yeah, I mean, it was like, whoa. And so she went, well, I have to say, in the oil crisis one,
Yeah.
I chickened out and I sold my IBM stock. Because I worked for IBM, I had a bunch of IBM stock, and I did really well. But it was just, I was lucky. I mean, I know I was lucky. I used to watch Louis Rukeyser. Anybody remember Louis Rukeyser? And I watched him on a Friday, and what he said about what was going on and scared me. And I went in Monday morning and I sold all my stock. By the end of the day, I had on paper saved a ton of money that I would have lost.
But did you have to pay taxes on it? Was it in your
Yeah, I
tax?
did.
Oh,
Oh yeah, but it's still,
still
About-
yeah.
you know. Okay.
I didn't know.
No, that was before. It was BC.
Okay.
But that's interesting. So yeah, sector, yes.
Anyway, thank you. I appreciate you guys staying till the end, and this is my contact information. If you want to work with me, feel free to reach out. If you don't want to work with me, there are some other options as well.
Now, Levanti, where do you work out of?
I work online, like I
Okay,
have all my meetings online.
okay.
I live in Etiquette City. I don't have a fancy office. I work out of my home.
So you have low overhead.
Yes. And yeah, I own my firm. I am a single person operation. So yeah, feel free to reach out. My website has a ton of information about my services, fees, the process, everything, and happy to do a complimentary call to discuss. And other options, if you're looking for advisors, don't like me, there's XY Planning Network, there's NAPFA, and there is Advice Only Network, which also has good resources. And I would appreciate if you guys could fill out this survey. It helps me improve my content and make myself better.